So I just worried that by the end of the year, if we just see a little start downticking in the gold, in the stock market, this trade into gold and other assets is going to become a pile-on, and we've seen it before. But the key thing that's happening right now is everything's fine as long as stock market's going up, and we'll just see how long that lasts. I look at it technically though. So it's stuck in this bull flag pattern. What makes it flip up and go above 3,500 versus what makes it stay below 3,000? Staying above 3,500 is a very easy case, I think. Just have the stock market back up a little bit, about 5%, maybe even unchanged in the year. That's only 8%. It's not a big deal. Making it stay below 3,000 and get back down below, you need some major paradigm shifts. You need the stock market to blast off maybe another 10%, central banks to stop buying, ETFs to start selling, and I think that's unlikely.
The Federal Reserve's preferred inflation gauge, the PCE index, ticked up again last month. June saw prices rise 2.6% from the previous year, up from 2.4% in May. Strip out food and energy, and core prices climbed 2.8%, matching the last month's pace, which was revised higher. The bump comes as President Trump's tariffs ripple through the economy, driving up some costs. But Mike McGlone, senior commodity strategist at Bloomberg Intelligence, isn't convinced the bigger danger is more inflation. The bigger risk now isn't more inflation, it's deflation, he says. Years of stimulus and cheap money have inflated asset prices far above their fundamental values. Human nature assumes the rally lasts forever until it doesn't. If stocks end the year lower, that would mark a turning point, and gold may already be flashing the warning light. The U.S. tariff disputes and economic jitters are adding to foreign investors' unease with dollar-denominated assets. Excessive valuations, artificial liquidity, and cracks in macroeconomic stability are all eroding confidence in U.S. fundamentals. Against that backdrop, central banks are continuing, and in some cases even normalizing, their gold stockpiling. Gold's appeal isn't new. McGlone points out that it thrives in both extremes. In inflationary spirals, people turn to it as a haven, think Venezuela or Turkey, while in deflation, when economies shrink and stocks fall, gold often outperforms all other assets. Its reliability spans centuries. The World Gold Council's latest report puts complex numbers to the trend. 166.46 tons of gold were added to central bank reserves in Q2 2025. That's below the frenzied buying of 2022 to 2023, but still historically high. More importantly, it's not speculative. This is part of a structural shift, a steady diversification away from the dollar that began after the 2008 crisis and accelerated in 2022 under the weight of sanctions. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Gold is both. It's an inflation and deflation hedge, and it has the most enduring history over time. So when we get pretty significant inflation, we all know, particularly if you're in a country that has a dicey currency, Venezuela, Argentina, Turkey, you just name the list, you always have that bias towards gold. And India and China have that bias to holding that rock. It makes sense personally on your body, whatever, because it protects yourself. And then when you have significant deflation, gold is always one of the best performers. When you have economies contracting, most notably when stock markets go down, gold can be one of the best safe havens. The key thing that's happening now with what you mentioned is gold absolutely loves President Trump. I mean, why not? Any president that pushes back on independence in the Federal Reserve, right or wrong, or pushes back on government data like that, right or wrong, is gold just loves him. I think is one of the main reasons that I think he's going to go down in history as the golden president, not the crypto president. And the key thing to remember about cryptos, people say they're inflation hedges. It's not true. They are highly speculative digital assets. And we're going to see that test. I think the key risk is that unlike gold, when we have a normal cycle towards normal deflation, which is only in the back of prices that went up too high and go down, which I mean the U.S. stock market, you're going to find out the risks of holding highly speculative digital assets have a high correlation to the stock market. Historically, gold's correlation is zero, and right now it's negative. So the key thing I want to point out about things like tips is tips are great if you want to just protect one-to-one against inflation. I mean, 100 to 100. If you have $100 to protect, you buy $100 of tips. But with things like gold, you typically can get what's called beta. If you have $100 you want to protect, you can oftentimes buy $20 or $30 worth of gold, and you get the same kind of protection. But you also get it in deflation too, which is what I like to point out. It's that beta that you get in things like gold, and typically used to be commodities, but not anymore. It's mostly just gold. So that's why I think the environment, I think what's happening a lot, and I see a lot of this in crypto spaces. I've been advocating and worried that gold's going to outperform the stock market. It's been doing for almost 5 years now. I fully expect it's going to continue to outperform the stock market and Bitcoin for the reasons that I'm very fearful of, that I pointed out earlier. The US stock market is just overdue for a bit of normalization correction. Now, we're not having that yet, right? Yet. But that's the key thing that I think people buying Bitcoin are going to get wrong is they are trading the last big trade. The last big trade, and we just saw this, we're about the same age, but we saw the biggest inflation of our lifetimes since other than the 70s, because it's the biggest money pump in history. One of the best assets to hold was Bitcoin and cryptos. That makes sense. But now we're at that stage, now we're tilting the other way. Like I pointed out, it's happening in China, the second largest economy on the planet, 1.7% 10-year note. You can't lie about that. That's the key thing you pointed out about data. Data is a lot of that surveys. But the key thing to remember about all those surveys, BLS, CPI, everything, is it's they check the natural self-correcting mechanism and check and balance. And people in this country that are like people like me who sit in front of this Bloomberg terminal and check everything is unstoppable. So I published recently, yes, the BLS only revised the data because they had to, because a lot of their data comes in late, the surveys come in late, and that's just but the household measure 4.2%, has been stuck at that level or around here for 12 months, almost unchanged. It's almost unprecedented to be completely unchanged. So it's ready to move. But there's ADP data has been ticking down. We just saw the latest ISM services index data dropping, and their employment data ticking down. They all completely confirm what the BLS revisions show us. So if they didn't, I would point that out, and you would see that from a lot of strategists. But that's the stuff you don't see in things like China, because I had a colleague who was there and made the mistake of countering something the president said, and she was technically detained for a year. But here I can say what I want. So that's the thing. Don't underestimate the private and the self-correcting mechanism in this country. But so to me, the bigger picture is now that anybody who's been involved in stock market or housing or condos, anything, they're definitely way overweight now because prices have gone up so much. And the problem is what happens with human nature is you always think you're smart and it's going to continue. And there's always some point it stops. Now, I don't know when it's going to stop. So I'll give you one example. Since 2008, we've only had 2 down years and a total return for the S&P 500. That was 2018, 2022. The market completely expects, is priced for, and consensus it's going to keep going up. Just imagine by the end of this year, Andy, if we have a bit of a down year in the stock market. That's a huge paradigm shift. And to me, that's what gold might be sniffing out by rallying so much. So I think the next big trade is that potential deflation. Everybody's all prepared for inflation. It's usually how things work. People cycle, look at the last war, and then don't focus on the next. It's the cycle is happening. And that's what I've been pointing out in commodities for too long. Crude oil is destined to go to $40 a barrel. I started saying that in 2022. Way wrong early, admitted, but it's just a normal cycle. Corn was destined to go to where it is now, below $4. I mention it because it's the most significant agriculture commodity on the planet. And just today, the Dees contract dropped below $4 as we get to harvest. Copper is kind of subject to the rest of the world, but that's where I point out that don't worry about the data. Mr. Trump pushing back on what is typically known as the best data source on the planet, because people like me can check it, is really good for gold. But don't worry, we have so much self-correcting mechanisms, independent analysts out there. We'll make sure we get the proper data. Like I mentioned, ADP is just one of them. I think the answer for some of what might be happening, it could include all the above. The bottom line for gold, what I'm suspecting in this country, is any wealthy investors in this country who are astute enough and have good financial advisors know they hold the most expensive currency on the planet relative to other currencies, and they hold some of the most expensive assets on the planet, U.S. stock market. And they've had a great run since 2009. Look at the dollar versus the rest of the world, and the gold, U.S. stock market versus the rest of the world, and the dollar versus the rest of the world. It's the same trade. And the smart thing to do is diversify. Now, you can go overseas. Obviously, there's a lot of that doing it. You buy assets overseas, or you can start with the rock. It's the simplest, easiest place to diversify. And the thing about the wealthy and the rock is you can hide it. You can put it in your underwear drawer. It's very, and physical, you can do that. So there's a certain just astute diversification, I think, that's happening, and the numbers are just massive. So I like to point out right now, the U.S. stock market total market capitalization is around $65 trillion. That's obviously the most ever, but to put that in context, it's almost double our debt in this country. and it's about almost the highest ever. So when people say we got a lot of debt, well, compared to the stock market cap, it's nothing. It's just how much we've pumped up risk assets. So I think what you're pointing out is what's happening, and I think it's just prudent diversification. And that's why you see, for instance, the key stuff I watch is I don't watch that stuff as close as I used to when I was trading futures. Now I'm just kind of macro analyst. I say it, I don't do it, is what's happening in the ETFs. They're kind of the most transparent. Gold ETF holdings, we have this pretty good metric on the terminal, and World Gold Council puts out for the last 4 years, there have been outflows. Every year, like, sell my gold, buy stocks, and buy bonds, or just buy stocks. This year, we've had a significant inflow, almost 10% jumped up. What is that, maybe 6 or 7 million ounces? That's the most we've had since 2020, the COVID year. So there's a major shift there. And that's despite the stock market going up. So I think what's happening is people are taking all that wealth and diversifying it into rock. And I've been pointing out the rock's been beating stocks for almost 5 years. So I'll end with this. The key thing that I like to watch, if you take the S&P 500 divided by the price of gold, you get a ratio there. And I shouldn't say gold divided by the S&P 500. Right now, that level is the highest on a closing basis since 2014. So that's almost, 10 years? And no, it's closing and the year basis. That my point is, if we continue on this format, now we've only have less than 4 months left this year, it's going to be a pretty significant trickle down trade. And I'm looking at it right now. It's August, everything's quiet, the stock market's wonderful, it's made record highs, and gold just keeps accumulating. So I just worried that by the end of the year, if we just see a little start downticking in the gold, in the stock market, this trade into gold and other assets is going to become a pile on. And we've seen it before. But the key thing that's happening right now is everything's fine as long as stock market's going up. And we'll just see how long that lasts.
Last week alone, investors funneled $14 billion into U.S. large-cap stocks. If this pace holds, we're looking at $419 billion in annual net inflows, second only to the record set during the peak of the bull market. But Mike McGlone sees a different story playing out beneath the surface. The U.S. stock market is the most expensive it's been in modern history, geopolitics are tilting in favor of hard assets, and central banks haven't stopped buying gold. Technically, gold's been in a bullish consolidation, and after a brief dip in late July, it's back near all-time highs. The real spark came last Friday. Jobs data showed the labor market is far weaker than the official narrative suggested, and gold surged on the news. Buyers still face that psychological $3,500 ceiling, but every dip keeps drawing fresh demand. McGlone puts it bluntly, a modest 5% pullback in stocks could be the push gold needs to break above $3,500. For it to sink below $3,000, you'd need the opposite: stocks rallying hard, central banks dumping gold, and ETF outflows accelerating. Right now, that's not the path the market's on. Let's get back to the interview.
Point out this year's been a great year, particularly for all investors who are overweight gold. I haven't been able to say that in a long time. It's up almost 30%. S&P 500 is almost 9%. Exactly. The key thing I want to do mention with Bitcoin, macro picture, big picture, this new digital asset versus old guard store value, having gold now and storing and investing in gold now without some Bitcoin in that space, I think is a bit remiss. But there's times to overweight the store value, low volatility, risk off asset, in times of overweight, the high volatility, speculative, digital risk on asset. And I pointed out the fact is Bitcoin has a very, very high correlation to the stock market. Right now, 100 days is about 0.6, and gold has last 100 days a negative correlation to the stock market. If you look at 100 weeks and 100 months, it's that way. So people want to tell you that you should hold Bitcoin as a safe haven. I say good luck. Hold treasuries and bonds, and treasury bonds and gold, and so far they've proven that case. The key is we still have a record-setting stock market. Bitcoin hasn't had that test yet, but to me, that's happening. The pile-on is what's the next big trade, Andy, that I'm worried about is going to kick in at some point. Right now, the last big trade has been Bitcoin and cryptocurrencies, but now it's become a bit of the old saying, they should be selling when the yelling's kicking in. Now the masses are on Bitcoin. The Trump administration 2.0 loves it, and they're supporting and everything. I love Bitcoin when Trump administration 1.0 hated it. And just point out the simple facts that the whole space is going to the dollars base layer, stable coins or crypto dollars. And by the way, these crypto dollars are invested in U.S. treasuries. Now, I love pointing that out in, Trump invasion 2.0 and 1.0, but now they finally tilted. The problem is now it's all been priced in. It's wonderful. And Bitcoin, when it was like about 10 grand and Michael Saylor discovered it in 2020 and his business wasn't doing well, so he bought Bitcoin. And now he's piling on that trade after it's gone up 10x. I say, good luck. This is a time you're supposed to be very careful. And to me, that's what's happening with gold and potentially bonds. And the only key trigger for that trade to accelerate, meaning treasury bonds and gold to take off, is the U.S. stock market to go down. That's why I'm so worried for the end of this year. And I hope it doesn't happen that way, but I think smart investors and astute investors are protecting themselves and figuring it out that, yeah, we can't just have this stock market go up forever, even though we have, and the bottom line also is what's happened with our new president. And even before President Trump came in, is one of the things that really tilted the bias towards what people call de-dollarization. Its favored goal was Russia's invasion of Ukraine, and of course seizing all those Russian assets. Now, when people push back on that, they say, what are we supposed to do? You got to do something. We can't just let them go in and take over the rest of Europe. But now we're at the stage where we have this new president who's pushing back on all conventions that really have made the U.S. stock market really expensive. Now, MAGA, I get it. MAGA, make America great again, but it's hard to get much greater than the highest stock market of GDP in 100 years and the greatest stock market cap in the U.S. versus the rest of the world ever. It's hard to get much better than that. And one key way that happened was independence of the Federal Reserve. The rest of the world could trust the Fed was not politicized, and the free open markets, they say, as Robert Lighthizer pointed out in his book, No Trade is Free, there was very much free trade for the rest of the world and for the U.S. an importer or any type of company in this country to offshore their production, boost their profits, close their plant in the Midwest, which we're both from, and just keep competitive. But now we're just shutting that off. Tariffs are going to be a major tax on earnings. And I think that's what's potentially happening. But the key thing is, like I said, two key things. We had a Russians invasion of Ukraine, and that war's still going on. China basically considered a decisive enabler, so it's becoming a World War III. Now it's from NATO, not from me, and Mr. Trump. And this is like a perfect environment for gold. And the question is, now I look at it technically though. So it's stuck in this bull flag pattern. What makes it flip up and go above 3,500 versus what makes it stay below 3,000? Staying above 3,500 is a very easy case, I think. Just have the stock market back up a little bit, about 5%, maybe even unchanged in the year. That's only 8%. It's not a big deal. Making it stay below 3,000 and get back down below, you need some major paradigm shifts. You need the stock market to blast off maybe another 10%, central banks to stop buying, ETFs to start selling, and I think that's unlikely. Unstoppable deficit spending is part of what's wonderful for gold. So it keeps me bullish gold. All the other stuff, I don't want to debate with you. I sure respect your opinion, but to me, it's what it means for markets that matters. So let's focus on that quote de-dollarization. It's silly because, okay, there's the three top holdings of central banks on the planet. First, the dollar. Okay, it's come down a little bit. The euro, and what's picked up the most since 2022 is gold. Central banks are buying gold. They ain't buying the yuan or the yen or any other currency that's dicey. It's still the cleanest shirt in the planet. And you know who's really the best? What's the best example for that is cryptocurrencies. The most enduring. I've been pointing out since 2018 in cryptocurrencies the proliferation of what people call stable coins. I call them crypto dollars. And we just saw the latest legislation where from the U.S. government, we finally figured out it's, hey, the space loves a dollar. And by the way, all these stablecoins are investing in treasuries. And by the way, every person on the planet now who can download a law can get access to this stable currency. It's the most stable, at least the cleanest shirt in the closet on the planet through their phone now. They don't have to worry about their melting currencies in Argentina and Venezuela and Zimbabwe so much. So the world is losing its peripheral currencies and all going to the dollar. But it's also remember, what do you want from a currency? Do you need something? Yeah, it's the most stable as possible. Right now, it's earning 4.5% yield, which is great. In China, you get 1.7%, and you can't really invest it anyhow. So that's very attractive. And the key thing to remember about a currency is you want to use a good store value and measure over time. But why would you spend it if it's going to increase in value, like maybe gold? Why would you spend your gold for anything? You want to hold that. But you need something you can spend and transact with that's as safe and stable as possible. That's why the dollar is still ideal. And I love to push back a little bit de-dollarization. What the Trump administration figured out by tilting towards cryptos is this is an unstoppable force. What happened with futures? Futures just took over a lot of trading because there's just a better way to mitigate risk, transact things, certainly in commodities and things like gold. And, you can see what we talked about that earlier. But the ability to be able to tokenize assets, number one right now is the dollar. through stable coins. And then there's going to be treasuries and stocks, and be able to trade them fluently in liquidity 24/7 and not having someone in between or an exchange like the LME that shuts down like Nikola did a couple years ago. Just a improved technology. And the reason that I'd say that's not just me, it really struck me in 2020. Laura Shin did a podcast. She's a main crypto podcast. Cy Sheffield of Visa. And he pointed out, hey, we're adopting crypto currencies, or not cryptocurrencies, but stable coins, because it's the best way to transmit, transact, and square out dollar balances. So that's a key thing I push back on dollarization is good luck with the BRICS. They are very, very disparate. And, they don't have anything really in common other than they were coined by Mr. O'Neill. Thank you. And certainly not geography, certainly not bond markets. And by the way, when the tanks come down from Russia, who are you going to call? Probably all the above. We have to figure that out. The best thing to do for Treasury demand is, as Scott Besson says, it helps if we increase the revenue. Now, we're doing that with tariffs, and that's somewhat debatable of how much we're going to do it. Obviously, they cut off, to kick back a little bit on the wastecraft and hubris and cheating in the U.S. government spending, which is happening. Okay, that's very debatable. And everything new and different is debatable. But at least we're doing that. I'm just, I had a colleague come in from our D.C. office recently. He says, yeah, a lot of her friends have been fired. And I feel bad for him, but at least we're doing things. We're trying to cut back in a lot of the government ways. At least they're doing something. I've never seen anything like that. Okay, it's not perfect. And then there's the main things we got to do. But the key thing I point out is at least they're trying something. That's the key thing I like to point out about what's so great about this country. It's our self-correcting mechanism. If this doesn't work, if this great Mr. Trump experiment doesn't work, we will know by the midterms there'll be some pushback, and certainly by the end of by 2028 he'll be voted out, and we'll have someone else, and they'll change the system. But we'll know. We'll at least try, and that to me is why it's so great. But the key thing is to not expect some significant discombobulation in markets during this period is unlikely. So that's what I think I have to tilt back to. The most thing that matters most for all markets is the U.S. stock market has to keep going up. It absolutely has to. And that's my point, is that's the risk, is at some point it's going to go down. And it's going to shift the world order. It's going to shift what all the assumptions we've had about, you're making a view about gold or copper or crude oil or even deficit spending or anything. You have to have this assumption that we're just going to keep going up in the stock market, because that's been so ingrained since 2009. And that to me is where the risk is. And that's why I always tilt over to what's happening in markets. Everything is to me is guided by what's the most speculative best indicators on the planet for where things are going is cryptocurrencies. So on the year, the Bloomberg Galaxy Crypto Index is up about 8-9%. That's the same as the S&P 500. That performance basically just sucks. I'm sorry, but it's just, I don't want to use that word so much, but on a risk-adjusted basis, you're taking basically 4 times that risk in terms of volatility to buy these highly speculative digital assets, and you should be outperforming the S&P 500 by 4 times, and you're not. So okay, it's just a short-term period, it's not happening. But gold is. So to me, this is what I'm looking forward to, and I think might happen this year. Can never predict the world, the future perfect. I think cryptocurrencies are going to be the first ones to go down, and then everything will follow, and certainly bond yields. And gold has been sniffing that out. So all the other stuff is just part of that big trade. And Mr. Trump is a big part of it. For instance, what happened with copper? The main reason U.S. copper spiked was because of tariffs. Main reason it's going down is potentially because of tariffs. And what's happening in the rest of the world and why they're tilting towards deflationary recession is because of U.S. tariffs.
Momentum in equities might be grabbing the spotlight, but the quiet, steady migration of capital into bullion tells a deeper story. The world's monetary gatekeepers aren't treating gold as a trade, they're treating it as policy. Even with record-high valuations in stocks and steady inflows into U.S. markets, the gravitational pull of tangible reserves remains strong. That combination of stretched risk assets and persistent accumulation of hard assets hints at a shift that isn't just cyclical, but structural. When official reserves continue to tilt toward metals despite record paper wealth, is the global monetary order already repositioning for the next phase of the cycle? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.